Hello, welcome to the live stream. I hope you guys are having a great day. Can somebody give me a thumbs up if you can listen and hear what I'm saying? All right, I hope that this is working. I'm gonna go ahead and start right now. If any case this doesn't work, it's gonna record exactly what I'm saying, and then it's gonna probably post it on YouTube later. So just to start off with the pre-market update, I was looking at some of the news. It seems like futures were down, and now it's back up. You know me, I don't usually follow the news that much just because I feel like the news overhypes things. It did point to futures dropping, but I believe that futures are recovered. And Fed had announced some unlimited QE and aids for some companies and municipalities. So the market actually kind of reversed and took a big green candle. So this is kind of like the start of the day, my routine, what I go through. I kind of read the news, but I don't take it for everything that it's worth. I kind of take it with a pinch of salt because I know that things can be manipulated. And I use two news outlets, Bloomberg and Wall Street Journal. I have a subscription to Wall Street Journal, but I don't have a subscription to Bloomberg. So I actually use Wall Street Journal more often than not. But I did prepare a kind of a brief for you guys today to kind of go through the live market update. So this is this week's live market update, and I can't wait to share with you what I have found. So the first things first, I just want to go through a little summary with you guys. I like to do a top-down approach. So looking at the macro situation, and the things to highlight here are going to be with U.S. equities and Chinese equities. So the first thing about U.S. equities that we need to note is that the COVID-19 headlines, they continue to grip the narrative, and it's still causing a lot of uncertainty in equity markets. There has been good sign that the Feds are willing to stimulate and do as much as possible to help the economy to recover, which is a really good signal, but it does also signal weakness for the economy as a whole, because this just means that they know that something bad is about to happen. And we have definitely confirmed that unemployment rates are going to rise. This is one of the things that are a trade-off of the COVID-19 virus, right? People are sitting at home. We have quarantine orders. New York is on lockdown. They sent the National Guard out. And so this is going to cause unemployment rates to spike. Right now, it seems like it's going to spike about 30%, which is a lot. That's really considered a lot. And S&P 500 as of yesterday was trading 35% lower than session highs from February. So the Treasury is scrambling right now to maintain the bond rates, because that's what's going to inject liquidity into the system. And essentially, they would want to make sure that the 20 years and 30-year bonds are going to be taken care of and maintained at a pretty decent level. So they want to flatten the right side of the yield curve. And I'm not sure if many of you know what the yield curve looks like, but maybe I'll cover that in a separate video, because that's an important concept to understand. Not to say the least, they're also going to be performing some bailouts for major businesses, which will now be expected as the economy falters further. And here's the main thing: credit risk for businesses are starting to falter. So we definitely want to see, some kind of credit risk fade away. But as of right now, I don't see that happening. So let's go through this really quickly. So I have now revised my SPY target to 195, 200 range. I think that we are going to drop to that level in the near, probably this week or next week. I personally think that's going to be very, very possible. And we'll see how it goes from there. But right now, it seems like we're going to definitely hit this by this week or next week. As for Chinese equities, we're seeing definitely China slowing down with their virus spread, which is a good thing. And the conditions seem to be stabilizing. I hear a lot of news that factories are starting to open up from my friends and people who own businesses that have goods coming in from China. And the strict controls that the country has actually performed has kind of slowed the spread, which is good. However, we still continue to see risk-off atmosphere as investors are seeking returns in less volatile and more stable instruments such as the US dollar and the bonds environment. So here is today's very important image. This is something that you should definitely take a good look at. We have unemployment rates versus the federal deficit, and the federal deficit here is inverted. So this graph is actually supposed to be facing down. But essentially, it's tilted upward, so you can see the trend on how things are increasing with each other. So key things that you want to watch this week is economic numbers and figures on the US budget deficit, which is now at about 5% of GDP. And I think that many news outlets are reporting that it's going to get to about 10% of GDP. But realistically, with the amount of problems that we're seeing with the slowdown of businesses, I think we're going to see almost 20% or 30% of GDP of a deficit, which is honestly a lot. And I think this is going to cause a much broader problem in the near future. This essentially causes longer dated yields to come under more upward pressure. So what I was saying earlier, the Fed has to maintain its focus on QE, which is quantitative easing, aka money printing, to ease the longer end of the curve, so that it doesn't cause a distress to the liquidity of the system. So you have to understand this. It's the money supply, and you have to understand liquidity because that is what drives our economy. A major difference of the 2008 financial crisis and right now, which is the COVID-19 crisis, this is not a financial crisis. This is a health crisis that caused a slowdown in businesses, but the Fed still has tools to leverage and make liquidity happen. So that's exactly what they've done. And this time around, they realized that the last time they did it far, slower. And so this time, they're acting quickly to make sure that they get this done. Now, we also expect full year GDP for the US to basically go down to negative digits this year. I think that the shutdown of businesses and the slowdown of consumer spending is going to cause this negative spiral that's going to cause GDP to contract. And as long as it contracts more than 3 quarters, we're going to be actually in some hot soup. So what we want to really hope for, if you're a bull, you want to hope for our GDP not to contract that bad, which is kind of imminent at this point. But at the same time, you may see a lot of pent-up demand that might shoot up GDP towards the end of the year. And then, of course, if GDP is going to be lower and there's weaker consumer demand, wage growth, this is all going to point to a lower core inflation value. And core inflation is the one to track here because of the fact that it excludes food and energy products, which is key because right now oil has had a big sell-off. Kind of everything happened at the same time. You have oil, you have the financial crisis caused by the COVID-19, and everything hitting at the same time. You have to exclude food and energy products from your inflation calculations because it's going to be the main things that drive your analysis. Now, another thing that we need to look at, which is severely important, let me just see if you guys are in this here. So corporate bond markets. This is another thing that many people are overlooking, and I think that you really need to keep track of this. We had corporate America at a very, very high risk environment before this happened. People were taking all kinds of risks to invest into high yield bonds, which were corporate bonds. And they basically boil down to two things, right? You have investment grade corporate bonds, and then you have the corporate junk bonds. And these usually tend to, give you a higher yield, whereas these give you a lower yield, but they give you, more stable returns. And you can see what has happened here with both of these ever since the virus hit, right? We see a huge spike up here with the rates, which means that people have crowded out of these bonds. And so now they're attractive again. And this is important because prior to this, a lot of firms were buying these bonds up, and now they've all rushed out of them. And this causes problems because corporate America depends on bonds for business activity. So they sell their debt, and the debt itself funds their businesses. Now, the Fed has engaged in the PDCF, which is the Primary Dealer Credit Facility, which was previously used in 2008 financial crisis. And this is something that has been frowned upon because when they used it the last time, the Fed is trying to essentially signal that these businesses, hedge funds and banks, are in deep doo-doo because these are essentially businesses that have caught themselves in a lie. They ended up investing in these high risk financial instruments, and now that their value has dropped massively, they're almost like worth nothing. So the Fed has to now transfer them onto its balance sheet and take ownership of these bonds in order to push the prices back up. Or they have to hold it for a period of time until the Fed eases the situation so that the prices stabilize. So the Fed is going to take on a lot of debt here, and in turn provide liquidity to the system by doing so. Now, the aim of this PDCF is to basically recapitalize bigger investors and provide liquidity. So the main people that benefit from these are hedge funds and banks, but there are other financial institutions as well. And as long as you don't see this situation fixed, we are not going to see a rectification in business environment at all. So these are important things that you have to keep track of right now, especially all the more as we move on. Remember that in a financial crisis, the important facts are going to be for mainly liquidity. You're looking at all signals for liquidity, and this week we have important news coming out for unemployment, and we have important news coming out for some inflation as well. So that kind of concludes this section of the analysis. This is just something that I wrote up for you guys so you can kind of understand that there are a lot of deeper things that you need to keep track of here, not just charts. But I know that you guys love the charts. So let's have a look at these charts right now. So here is a important thing that I was tracking this morning. Prior to this crash that we have had two bear markets that happened in the past. One of them was the dot-com bubble, and one of them was the 2008 financial crisis. Now, during the 2001 dot-com bubble, I just wanted to kind of go through with you guys how big a drop can get during a financial crisis or a crisis of any kind. So if you look back to the dot-com bubble, you'll see that we actually, from the top to the bottom, lost about 45% in value. And during the 2008 financial crisis, we lost about 53%. If you average these two out, you would get roughly about 50% or 49%, something like that. Now, if we look at this financial crash, or I'm not going to call it a financial crash, but this crisis, we have so far dropped, as of today, about 35%, which means to say if we really do continue to drop this much, like as the previous crises, we should actually go down to 50%, which would be the 170 level. Now, the reason why I chose 195 to 200 level as a level to which we can realistically hit is because that is going to be the next support for the SPY. And I've drawn a Fibonacci retracement here for you guys because at this point you can't use support and resistance. Support and resistance for a daily chart in this environment does not work. So you need to look at other things that track the retracements in terms of mathematical and probability wise. Now I do see that SPY may actually kind of go back up to the 38.2 Fibonacci. And if we do hit that one, we're definitely going to go back up to the 50. So these are two key points that we will see a retracement to. We will test the 223.6 first, which is going to be about 250. And then if we do break that, we'll go to 260-ish and then 280. Then this will be your key level for entries into put positions once again, as I see our market continue its meltdown. So the technical aspect of this can be studied further if you look, into the market participants, how things are going. Until and unless we don't see a narrative change, we are not going to see improvement in this market. And right now, everything is narrative driven. It's all news driven. We're seeing definitely defaults on all levels. Airlines are getting murdered. You have businesses that are just shutting down and closed. They can't operate in this environment. And so I definitely see SPY falling even further down in extension. However, as I said, nothing can go down in a straight line. So we have to wait for these pullbacks to enter into the next put position. And you want to definitely wait for the retracement up to 250 or 260 in order to get into the next round of this bear market. So yeah, that goes kind of like my pre-market analysis for this week. To know what is going on. Corporate America is officially in a bear market. We are definitely trading well below estimates and we are free falling. However, today we may see some liquidity flow back into the system. The Fed just said, we're turning the taps on, guys. We're going to give you guys free money forever. And so this will be something that might turn the market around for a short period of time. And that kind of concludes my technical analysis. And now we can go and do a Q&A. So let's see what you guys have to ask today. I'm willing to answer any of your questions, so definitely ask away. I think there's a little bit of a delay in the stream, so I will answer them as soon as I see them. Go ahead with the questions, guys. No questions? Come on. I'm sure you guys have some questions. Do we hold our current SPY position? It depends on what position, man. I definitely think that if you're holding puts, I think today, depending on where we see SPY go to, I personally have puts, 230 puts for the end of this week. So I'm going to be holding till the end of the day to see what's going to happen with them. I don't feel comfortable selling them right now, just because we had a little bit of a gap up in the morning. I think that we will continue to sell off, but this Fed news is going to definitely push things up a little bit. Okay, can you do one of these every Monday to Friday? Yeah, I was definitely playing around with the idea of doing one of these every Monday to Friday, but I need to definitely come up with a lot more content that I can stream to you guys. And so you can be rest assured I'm definitely thinking of doing one every day, but maybe for now I'm going to keep it to 2 and then slowly increase them over time, because this does take almost a third of my day to put together. Yeah, you might think it doesn't take a lot of time, but it does. And then let's see, can you run through your checklist for scalp trading? Sure, definitely. Okay, so just to kind of give you guys an idea on scalp trading, let's see if I can bring this up again. Okay, just a simple kind of idea here. And I don't know if you guys have seen my indicator list before, but I like to keep it simple. I don't like to butcher my indicator alerts. So I use like what, 5? Yeah, I use let's see, let's put this on here now. Okay, so this is what my active trader indicators look like. And essentially for scalping, what you really want to see is, so the idea of a scalp trade is to basically go through a process where you have recognized that your instrument has broken through a key level and is broken through that level on high volume. So for example, just to give you guys an idea, if you were to see this happen yesterday, okay, this was SPY yesterday at the close, but let's just assume that this is SPY now, just for an example, okay? If SPY broke down below support with this amount of volume, and my indicator for the on-balance volume shows that a lot of volume has flowed out, which is denoted by the scale on this side, I could safely take a scalp position for a put here. Now, I know your next question is going to be, so which contract do I buy? Well, the contract that you would buy would be, if you're doing a scalp position, would be essentially a put for a weekly contract, and you would take the put to be in the money. I would recommend, like, if you were to take a put here, I would go something like 229, right? And then you write this down until it touches another support zone. And then you take your profit at like 5%, 6%, or 10% if you can achieve it. Because it breaks on so high volume, and it breaks a support, that's the general idea that you want to go for. And this is inversely true for resistance. So if you see SPY break the resistance and it breaks on big volume, so you see OBV swing the other way, and then you see, maybe the RSI is oversold, that would be a perfect position to take a scalp for the upside. And the same thing, you would buy calls and you would do in the money calls, something like 235, and then play that to the upside. So that's not obviously all the things that you need to look at, but those are like the important things you need to look at when you're thinking about put positions, for scalp positions. All right. Next question. What do you think of UUP? Okay, let's see. Let me look at UUP. UUP, what is this? Index, Invesco, dollar index. Okay, well, dollar index. So as you guys know, right now that everybody is risk off, what's happening is that people are rushing towards the US dollar. And the reason why people rush to the US dollar in an environment like this is because the US dollar is the most safe currency to hold in a crisis situation, okay? Through any kind of a risky financial situation, everybody's going to rush towards the US dollar. And that's simply because it makes up 60% of the world's currency. And a lot of the financial instruments that we denote in our financial markets are against the US dollar. So by holding the US dollar versus those instruments, you get an instant swap for holding, and you get a benefit by holding the dollar against those financial instruments. So with this UUP, which is dollar index, I see that it's spiked up and it's showing kind of recovery here, kind of going down a little bit. However, I do see as the market continues to go down, I think that there is a basis for this to go even further up. It's kind of like the whole situation with VIX, right? If you look at VIX, let me try to show you guys VIX, right? And actually, I forgot to mention VIX because VIX is an important thing here too. So here's VIX. And I want to show you VIX on the monthly because this is super important. So throughout the previous, the financial crisis that we had in 2008, VIX actually went up close to $100. It was somewhere like $96. This doesn't mean that VIX will go up there, but the dollar index tends to behave similar to how people view fear. So whenever there's fear in the market, people run towards the dollar. And you saw initially when the fear wasn't that much, people were getting into gold and people were getting into bonds. And now that the fear is overblown, they're like, you know what? I don't even want to hold any financial assets right now. Like I don't want equities. I don't want bonds. I don't want nothing. I just want to hold cash. And that's the reason why UUP has gone through this spike, and you can see it's just gone insane, bonkers. And the US dollar is strong against major currencies, except for right now against the ruble. And so you really want to be careful playing UUP, because I don't think it's safe to play on a daily basis. You might want to wait for this to break this resistance and then start to short it up there. Let's see, what else do we have? Okay. Average down and puts, attendees already. What will happen to bond rates? Okay, so this is a good question. What will happen to bond rates? So from here, I see bond rates going definitely into a frenzy. As we see further Fed injection of liquidity, we're going to see the price of bonds definitely go up. And the reason is simple. So bonds and rates of bonds are inversely proportional. So as you see, if the Fed injects a lot of money into the system and performs quantitative easing, that means that they're going to be buying all these bonds. And if they buy bonds up, then there's less bonds out there. And if there are less bonds out there, this drives the rates that bonds are trading at lower, which causes the bond prices to spike. So you're going to see bond prices go up, especially TLT. This one's a key one to watch, and I'll be watching this one closely. You're going to see inflows and possibly, retests of highs. I definitely think this, for a longer term play, waiting for a retracement for TLT and then getting in long is going to be a good trade. And let's see what else is there. Okay, great content. Thanks for investing. Oh, no problem, man. I enjoy doing this. How long would it take to bounce 250 before we fall down? So, I mean, I don't really know how long it's going to take for us to bounce again. That's like a really crystal ball question. But I definitely see us hitting those levels sometime within the next month. Don't forget that those bear markets that I showed you guys earlier, they lasted for a year. This one only has been a month. And so, you know what they say, sometimes the faster the fall, the faster the recovery, and that may happen. But this next uptrend that's going to form to hit these FIP levels are going to be all opportunities for you to take put positions, because I don't see the market recovering so quickly from this. And let's see, what else? In a market like this, do you follow more fundamental than technicals? Well, it's a mix of both right now, and I try to avoid relying too much on one thing, but I've mentioned before in my videos, I use a 60-40 approach. So I use a 60% fundamentals and a 40% technical analysis kind of approach, and that kind of helps me to navigate the markets a little better, because I hate to put everything on technicals or give a higher weightage to technicals, simply because support and resistance levels can be easily manipulated by market players. And let's see, what else is there? Thank you for your time. None of that looks easily put together. Trading plan, what do you think? JNUG. And let's see. JNUG, that is another one that is interesting, right? JNUG is the direction for gold miners, yeah. So JNUG got murdered. And these are the bull shares. Well, JNUG is also a ETF that is, I believe, inverse. Let me check to see what's going on with this one. Yeah, it is an inverse ETF. So with the JNUG, as gold is going to be, I think, more sought after in the coming weeks, you might want to, keep track of this one and put it on the back burner. But I'm going to definitely have a look at JNUG a little deeper and give you my analysis, perhaps in a separate post, because this one's looking all weird to me. There's too much movement up and down, and I just don't like the way this is moving. It doesn't make me feel comfortable now analyzing this one. What are your thoughts on leaps right now, or fundamentally sound companies? So I have mentioned this before. With fundamentals of solid companies, my pristine watch list right now for companies that will recover very quickly after the this whole situation is over are Tesla, I see Tesla recovering back at least to the midpoint at 600. However, we don't know when this is going to happen. As the market continues to sell off and this risk atmosphere continues to go on, we're not going to see people pour back into equities just yet. So you might see a spike in SPY for a while, but it's not going to be very long lived. It's going to be a setup more for like a bigger sell. And I think that remaining, if you have shares in Tesla right now, the best strategy for you to do, since the premiums are so wide, is to sell calls on Tesla and do it on a weekly basis to deliver additional gains to your portfolio. For example, let's say Tesla's trading here right now, right? And it's trading at 420. Well, what you could do is buy a weekly contract for this week and sell a call for 500, right? And if Tesla hits it, well and good. You sold your 100 shares at 500 if you had bought them on the bottom. If you had bought Tesla at 600, then obviously don't do that because you wouldn't make any money there. But if you bought 100 shares of Tesla somewhere in this range, you could sell a covered call at this top of your range and lock in your profits, while if those calls are never exercised, then you're going to collect the premium on those contracts, which can be really big. So that's just one strategy you can use. The next company that I really like is Microsoft. I've been a long fan of this company. It's a no-brainer to own this company for the longer term. This company is excellent. It has a good economic moat. And who doesn't use Microsoft, right? Everybody uses Microsoft. The other thing is that recently Microsoft's Teams has been increasingly used. During this whole coronavirus, we're going to see more users start to use Microsoft Teams because they're stuck at home. Of course, they'll use Zoom as well, or Slack, or any other thing. But I believe I read an article saying that 20 million more users have, jumped onto Microsoft Teams, which is really great for Microsoft and to monetize their platform. Next company, Amazon. This one remains one of my all-time favorites. If you got into Amazon at the 1,600 level, you are making bank right now. And I continue to like this company because of the diversification model of the business. Amazon has its hands in everything. And the major behemoth that makes Amazon is AWS, which is Amazon Web Services, which is going to be a formidable contender to Microsoft's Azure cloud. And then during the situation where businesses are online, operating everything online, Amazon, it stands to benefit from this situation. And in fact, Amazon is a really good, really good situation right now for the fact that they just announced that they are hiring a whole bunch of people during this downturn, right? They just actually put out an article. Like I saw something about Jeff Bezos saying, hey, if you got laid off, come join us. Like, we need people. We're hiring 100,000 people. And that's actually a pretty good sign for the company because it just shows that they can't keep up with the volume of people ordering things. So as this company continues to go on, I have an intrinsic value calculation for Amazon somewhere. I'll probably show it to you guys next time. But I have it priced at about 2,500. Now, obviously, we're not going to hit 2,500 anytime soon, as this market is barely risk savvy right now. But in the long run, we will see Amazon hit 2,500. Whether it's this year or next year, I don't know, but it will hit it. This is based on the discounted cash flow method for a 10-year exit DCF. So we will see Amazon recover at some point. I personally like accumulating shares somewhere at this level between 1,006 and 1,007. And I think that it's definitely going to be a good addition to your portfolio in the long run. It's expensive, but it's one of those things that will for sure recover quickly. And then the next one that many people are probably forgotten and probably think that this one's just like doo-doo, right, is Facebook. And I've done an analysis on Facebook. If you go look at my YouTube series, which, by the way, if you haven't subscribed to, please click on the subscribe button so that you can get more updates and stuff. But Facebook has an intrinsic valuation of about $260. And Facebook is also going to be one of the businesses that are overlooked during this time. As people are stuck at home, what are they going to do? They're going to play games. They're going to, go talk to their friends using Facebook Messenger. Or they're going to, watch ads on Facebook or communicate and post status updates about how White Claw is a better drink than Corona, or something stupid like that. The engagement of Facebook is going to remain, and if anything, they gain more users. They won't lose users during this time. So which means their earnings probably won't take a huge hit until and unless something crazy happens. So Facebook's another good one that I find is severely undervalued right now, and I think that there's a very good upside. But as I said, like, cheap can get cheaper. Right now, the market's selling off. Facebook's selling off with the market. So you have to wait till the market turns around and then execute your share purchase. All right, and what else is there? What are some top picks to start building a long-term portfolio? Okay, I just went through that. Those are my top picks right now. The 4 that I just mentioned: Tesla, Amazon, Facebook, Microsoft. And then, what do you think of Elliott Wave principle? In your opinion, is it accurate? In my honest opinion, I don't follow the Elliott Wave principle that much, but I have heard from other technical traders that it is accurate. I'm going to be really honest and tell you that I don't know much about Elliott Wave theory. However, I would be definitely open to learn and add it to my repertoire of skills. So I don't want to misguide you and tell you something that I, am not familiar with. All right. Well, if that are all your questions, does anybody have any other questions for me? Let's see if we can get a few maybe last-minute questions here. By the way, I hope that the stream was okay for you guys in terms of the buffering speed and stuff. I'm using a pretty, I'm using a Surface Pro, so I don't know if it worked out well, but let's hope that this worked out and we can do this more often to give you guys my pre-market analysis. So for today, I definitely see, let's look at SPY on the intraday so that you guys can get a good idea on what I intend to see today. So here, and so once again, I use a 10-minute or a 5-minute for SPY intraday, and obviously TradingView is not going to give me the live price right now, so I use just a demo account on any broker that you can find, and this gives me live price action of SPY throughout the day. So we saw in the Asian markets today, we saw a gap down, and then SPY was kind of trending up like that. It was kind of just hugging the moving average. That's what it was doing. And then you basically saw SPY shoot up. This is SPX, but it's the same. It's SPY. It just has a different price structure. But you're going to see SPY's probably going to try and hit this Fibonacci level here. So I've drawn my Fibonacci's into here as well. We're definitely going to see a retrace of the 23.6. So expect SPY to go up to test 250 today, which would be a key level. If you wanted to kind of see the 15-minute, that's what it looks like right now. I definitely see us going up to test this level here, which was the resistance of Friday. So we might see SPY kind of go up here and then come down a little bit, go up, come down, ultimately testing this level up here. And that's going to be my strategy today. Let's see where these puts open up. I was in some 230 puts. They should be basically not making any money right now. I think they'll be in a deep doo-doo situation. But I'll see how I'm gonna get out of those, because I'm probably gonna wait till Wednesday to sell them. And yeah, so okay, regarding FB, many businesses won't open, so they won't be able to sell ads. Also, ad rates will be low now. Do you still think the FB intrinsic value will remain 260? Yes, I definitely agree with you there about them not selling ads. But here's the thing: online businesses are still going to continue to advertise, and even if brick and mortar businesses are going to stop their ads, Facebook has kind of like done a push into offering a huge bunch of free ads right now, which is going to just entice people to sign on and hopefully retain some of that. So we're definitely going to look at, even though Facebook not having the same intrinsic value as prior to the drop, we'll see its earnings not go far away from where it was. Even though business has slowed down, people are still going to advertise so that when this all blows over, people remember who those businesses are and they start to invest or start to spend on those businesses. Um, so yeah, I even though I don't see it going to 260 anytime soon, I definitely feel that we will see a retest for 260 in a year from now, perhaps.